Welcome to the Secret Math of Money. This show is meant for entertainment purposes only. I hold no financial certifications or information that is not generally available. No guarantees are stated or implied. It is your money, and you are responsible for any decisions you make regarding it. Well, good morning, everybody. Today is Saturday, January 28th, 2017, and this is the Secret Math of Money. Welcome, everybody. I hope you enjoyed the show last week, or 2 weeks ago, actually. We did the last episode. And I hope that we are... Wow, it says I'm not calling in. Okay, I'm not going to worry about that. I hope that you enjoyed the topics. Couple things. If you want to send me a topic for a upcoming show, if you want me to talk about something in the future, you can hit me at thesecretmathofmoney@gmail.com, or you can go, and we also got a YouTube channel up, so these videos will be up on YouTube as well as in iTunes as a podcast. So anyway, let's talk about this week's topic is mortgage myths. First of all, let me say this. I am not selling you anything. I am not promoting anything. I just want people to understand how the math works. So I'm not trying to sell you any products or services. I just hope you listen. Take this as entertainment. Okay. Hopefully you will have a better understanding of how your mortgage works. That is the intent. That is my goal. Okay. So take everything, you can say, call this entertainment, or take everything with a grain of salt. So let's talk about mortgages. For most people, the biggest thing you will buy in your life is your mortgage. That's the biggest debt you will have, is the mortgage for your house. A couple of reasons why people get mortgages. We're not going to go too much into that, but basically one of the biggest benefits of a mortgage is that tax write-off. You get to deduct from your income the interest and taxes you pay on your house. Again, consult your accountant for your individual situation, but that's why people get a mortgage. But what gets me is, and I ask this question, how many people out there have actually done an amortization table? And the amortization table is how the bank determines what your payment is. Let me explain to you how this works. You're going to pay for this house for 15 or 30 years or 20 years or whatever your mortgage is. The first payment you make on that house, probably 95% of what you pay goes straight to interest. Okay, you're paying the bank first. Over that 30 years that you're paying the bank first. They're getting their money first. Okay, that's the thing. Remember that the bank is getting their money first. Okay, every month it slightly shifts a little bit, where every payment you make, a little bit more goes toward the interest. A little bit more goes to the principal and a little less goes toward the interest. But understand, in the first year, an example I'll use is a $200,000 mortgage. Don't get caught up in the numbers too much, because I'm not going to try to, just want to give you an idea of how it works. On a $200,000 mortgage at 4%, your payment is going to be $954 a month. Now, that's just the mortgage. That doesn't include any taxes or escrow or insurance or anything else. Just the mortgage. In that first year, you are going to pay $11,500. Okay? And of that $11,500, I've got my spreadsheet right here. I'm doing it as we speak to show you the numbers. Of that $11,000, $8,000 is interest. Okay, so you're paying first year. Now, I'm not saying the bank's ripping you off. I'm not saying anybody's doing anything illegal. I'm just explaining to you how the math works. Okay, so most of your payment is going toward interest. Okay, and the reasons for that, and I'll try to get into a little bit. If you refinance, and we'll talk about refinancing later, but if you refinance, say 5-10 years in, the bank gets to pay off, your house gets paid off, and you get a new mortgage. But the bank got their money. Okay, they got a whole lot of money up front. So that's why, you can say the calculation is front loaded or whatever. This is just how the calculation is. This is not anything secretive. This is not anything where they're ripping you off. This is just how the calculation works. Okay, so the first couple of payments, couple of years, 10, 15 years, a big majority of your payments are going toward the interest. You probably won't, on a 30-year mortgage, you probably won't go get to the 50% mark until probably around year 13. That's when half your mortgage payment will be going toward the interest and half will be going toward the principal. Now, why do you want to eat down your principal? Your principal is what you borrowed. Say if you have a $200,000 mortgage, your principal is $200,000. Okay. So every month, the first month you make that $954 payment, $666, nothing to do with the devil, but $666 of that mortgage payment is going toward interest. And only $288 is going toward principal. Okay, that's just how the math works. Okay, so you've eaten into your principal what you owe them by $288. Back 10 years ago, when the stock market, when we blew up the market, there were all kinds of weird mortgages out there. When you go for a mortgage, most mortgages, you got to show them what you make, what you owe, everything. They crawl up all into your underwear and everything. Back 10 years ago, one of the problems we had was that these people had these, they call them ninja, no job, no income, no job, or something like that, where people were actually getting mortgages without having to verify that they actually had a job. Okay, they were able to write, I make this much money. Okay, we'll go with that. And based on that, we think you get this mortgage. That was part of the reason that everything blew up, because people could make up what they made. And think about how crazy that is. You go to the bank and say, I make $1 million a year. They say, okay, we'll loan you $100,000. Here you go. Have a good day, sir. It's not going to happen anymore. At least it shouldn't. If a bank does that or anybody does that, if anybody tells you they'll give you money without you justifying your income, all I will say is just think about that a minute. Why are they doing that? Okay. So anyway, that's how mortgages work. Every month, a part of your payment goes to principal and a part goes to interest. And over the time of the mortgage, that shifts. So by the time you're in your last few years of your mortgage, most of your payment is going toward your principal. So you're eating down your balance. Now, here's one of the myths that I heard, and I don't know if other people did hear it, but 15, 20 years ago when I got my first place, they said you should refinance every, say, 5 years. After 5 years, you should refinance because you won't get as big of a write-off as you did the first 5 years. Now, let's take a step back and think about that a minute. Your goal is to pay off your mortgage. I mean, you're thinking 30 years down the road, but still, your goal is to eventually pay off your house. Okay, your goal is not to just have a payment forever, at least not mine. What this myth was saying is, because you have paid a whole lot of interest and you're not going to pay as much interest in the future, you need to refinance. Now, when you refinance, the mortgage is paid off and you start all over. So you start all over with a whole new interest stream. So say if you got your interest down to, you got your payment down to where, 60 or 50%, no, say 70% of your payment is going toward interest and 30% is going toward principal. And then you refinance and all of a sudden that 70% shoots back up to about 90 and you start all over again paying off, you're paying another bank or whatever financial institution you got your mortgage from. Okay. The reason, and so first of all, that doesn't make sense. And I believed it because I didn't do the math. And when I did the math, we're talking about amortization tables. All this math, if you create an amortization table. Now, there's a lot of credit or calculators, mortgage calculators on the web. There's tons of them out there. Just Google it. But where you plug in a number and it tells you what it is. What's happening behind the scenes is there's an amortization table and it's pulling the numbers from there. I would suggest, if you know anything about Excel, even if you just know how to open Excel, build your own just for ha-has, just so you can see how the math works. Me preparing for this episode, I built my amortization table. I Googled it and it's all there. Here's the formula, boom, boom. And it's really straightforward. But once you see how the numbers work, then you go, oh, okay. So that idea of refinancing after 5 years didn't make sense. When you look at how the numbers go, yeah, you're paying interest and the interest is in an arc. The interest goes down as you pay off your mortgage, but it goes down in a smooth arc. It's not that it goes 5 years, then it drops. Okay. One thing we need to think about is if you have an adjustable rate mortgage. I'm not going to say whether it's a good or bad. Some people think it's a good idea to have an adjustable rate mortgage. just understand adjustable rate mortgage has got people in a lot of trouble because basically you have a low rate for 5 or 6 or however many years or 2 years even, and then the rate resets. So your payment might go from, say, $300 a month for the first 2 years, but then that third or fifth year, whenever that rate locks, you might go from $300 to $1,000 a month. It's not illegal. And I'm not saying it's a bad thing. For some people, they find, they're planning to sell their house in 2 years or whatever. They say, yeah, I want to go this to get a low rate for while I'm doing it. It's your own business. But as I keep saying, just understand how the math works. Okay, I will say that over and over. This is money we're talking about, people. And people do not like talking about money. But money impacts everything we do. But yet people don't want to talk about it, okay? And that is what I think makes a lot of people end up in a situation where they don't have as much money as they thought they would have because we're not talking about it. So just, again, Google how to build an amortization table in Excel. And boom, there's a formula, stick it in Excel. Even if you don't know Excel, stick the numbers in and boom, there's your table. And then you'll see how the numbers work. I'm not saying anybody ripping you off, and I want to keep saying that because I don't want anybody to get the impression that I'm here trying to tell you that the banks are bad. I'm not saying that at all. I just want you to understand the math as they understand the math, so you understand what you're getting into. So anyway, that was the first myth, was that refinancing. After 5 years, because you want to refinance because you don't have big enough of a write-off. That write-off is nice. Oh, and that's another thing. If you're thinking about the benefits of renting versus owning, renting, yeah, you can get up and move after your lease is up. If you rent, and it's a personal choice, just know that you don't get that write-off. And if you are a first-time homeowner, that's one thing I've talked to people. Hey, Jackie, my 9th grade homeroom. One of the things that people are surprised with when they buy their first home is that first year when they get that 1089 or whatever the form is they get and put it in with their taxes, and they see how much interest they paid, but more importantly, they see what a write-off they get and how it impacts their tax return. You get a ton of money, okay? So if you want to rent for whatever reason, that's your business. But understand that if you do rent versus owning, there is a tax write-off, a tax benefit. And I know people who are paying rent that is within $150 a month of my mortgage. Okay, so it's not where your rent is so much lower than mortgage. Because understand this: if you're renting a house, you're paying somebody else's mortgage. So if I'm renting my house and my mortgage is $1,500, I'm not going to charge you $800 to rent it. I'm going to charge you $1,600. Okay, so you're paying my mortgage. So in some respects, you might think that owning a house is cheaper than renting. Okay. So anyway, so we're talking about this arbitrary $200,000 mortgage at 4%. Your payment is $954 a month. Here's something. Now, people will get caught up thinking about what interest rate they're paying. I'm only paying 3% or 4% or 5% or whatever, and we get focused on that number. What is our APR, annual percentage rate? I have a new number that I like to look at, which is what I call true interest. And what is true interest? True interest is you borrowed this much, you paid this much. I don't care if you paid it over 30 days, 30 weeks, 30 months, or 30 years. You borrowed this much money, you paid this much money. Yep, thank you. If you want to lower your interest rate by 1%, it does have a big impact on your payment. A lot of times you'd be surprised with that 1%. That's one reason. I'll get into reasons to refinance, at least my reasons for refinancing. But what I was saying was true interest. On a 30-year mortgage where your interest, your APR is 3%, you know what your true interest is? It's going to blow your mind. It's 52%. What does that mean? That means over the 30-year period, if you borrowed $200,000, you are going to pay about $105,000 in interest. Now, again, it's over 30 years, so you don't really see it. But I'm just saying, what are you paying? You're paying 52% interest to borrow that money. If you had to pay that mortgage off, if you had to take all those 360 payments and collapse them down into one big payment, you're going to pay 52% for borrowing that money. If you're at 4%, you're going to pay 72%. If you have a 6% mortgage, you're paying your true interest is 116%. Again, it's over 30 years. It's over 30 years. So it's not where you're, a loan shark is you're borrowing money on Monday and on Tuesday you got to give him back double and a half. It's over 30 years. And for that reason, we don't think about it. We focus on that APR number. And that's a good number to focus on. I'm not saying that, but that number drives everything else. That number drives your payment. That number drives what your total interest eventually is. Okay. But just understand your true interest. If you go down to your buddy and borrow $50 and you say, man, let me borrow $50. I'll give you back 75 next week. 50% interest rate. That's a 50% interest rate, okay? Because you're paying 50% more than what you borrowed. So just, again, I'm just saying, understand what the number is. So for me, now, how do you reduce that true interest number? It's not really easy, because you had to borrow the money, and it's going to take you a long time to pay that money back, most likely. Hit lotto, and then you can pay it back. That's how to reduce that true interest. But just understand the true interest, okay? So, but anyway, so we were talking about 5 years. In 5 years, if you decide to refinance on a $200,000 4% mortgage, in 5 years, you will pay $38,000 in interest. Your principal you will still owe $180,000. Now, so you paid $38,000 to the bank for borrowing the money, but your amount you owe only dropped down $20,000. So you paid about $58,000, but that's how it was split up. Excuse me. So again, I just want you to understand how the math. I'm not saying mortgages are bad. I am not saying that. I'm just saying understand how the math works. Okay. So again, that true interest number is what you pay totally. Take the 360 times $954, and you'll come up with a big number. Divide that by the 200,000 you originally borrowed, and that is your true interest rate. Okay, just be aware of that. We are focused a lot on our society on the APR. What is the interest rate annually? And just understand that is a rate that's charged on your outstanding balance annually, but that's not your true interest. Now, here's well, let me talk about refinancing first. Okay. Why would you refinance? This is my opinion. These are just my opinions, my 4 reasons I came up with for refinancing. One is, as the vet said, you can lower your interest rate. If your APR is 5% and the banks are offering 3%, you want to refinance? Hey, go ahead. Now, there's all kinds of fees that you're going to have to pay in there, and sometimes they roll it into your payment. I'm not going to get into that. But I'm just saying, why would you want to refinance? One is to lower your interest rate. Another reason is to take equity. And what's equity? Equity is you got a $200,000 house. You owe, in this example, I said after 5 years, you owe $180,000. You got $20,000 in equity. That's the difference between 180 and 200. That's your equity. That's what you owe free and clear. So say if you need, mama need a new pair of shoes or whatever, you want to give a reason that you need some money. One of the things people do is just refinance their house because they built up a lot of equity over the years. The housing prices have gone up, so they may have a nice chunk of money sitting in that house. So they'll refinance and they'll take out a loan for that. They'll basically borrow against that equity because the bank says, well, you owe 180, but we think your house is now worth 260. So we will loan you $260,000 and pay off your $180,000 mortgage, but you'll have $80,000 in your pocket. Okay. How, hey, that's one valid reason. If you have a reason you need that money for whatever. Okay. That's 2 reasons. You want to reduce your payment, and that goes into getting a lower rate. You might want to go from 30 years to 15 years, pay your mortgage off a little quicker. So those are the 4 reasons, take equity, reduce your payment, get a lower rate, or reduce your term. Those are just my 4 reasons. You may have all kinds of other reasons, that you may want to refinance. There's nothing wrong with refinancing. Later on, one of these shows, we'll talk about the stock market, and we'll talk about what happens when you refinance, because there's a whole lot of math that goes behind that, and there's a whole lot of people investing in you, and it's interesting to me because I'm just a numbers geek like that. But one of the things, I'm going to relate a lot of things to the stock market crash of 10 years ago, because a lot of this stuff feeds into what happened 10 years ago, what really happened in the stock market. Okay. Hey, sis, if you're looking to buy or sell, hey, get the commercial in there. It's all good. But anyway, so now here's the thing, a mortgage myth, another myth. The first one I said was when people suggest you pay off your mortgage or you refinance after 5 years. Hey fam, ain't no problem. You know, that's what we're here for. One thing that people told me was that you should make one extra mortgage payment a year, and that will cut 5 years off your mortgage. That is absolutely true. If you make on a regular standard $200,000 mortgage, math should work on all of them, but if you make one extra payment a year, you will cut your mortgage from a 20. Oh, my brother's listening. Hey, okay. If you cut your mortgage, you will cut your mortgage from a 30-year mortgage to a 25-year mortgage just by making one extra mortgage payment a year. Now, here's the problem. If your mortgage is $1,500 a month, coming up with that money for a lot of people is hard. Okay. Now, how does it work? Well, again, if you do an amortization table, I mean, I got one. If you email me, I'll send you mine. You know, if you email me at, it's not copyrighted. I just played around in Excel. The email address is thesecretmathofmoney@gmail.com. Okay. It's nothing proprietary. I just Googled it and found it. So, but the thing is, the math works a certain way. Okay. That's the thing. The math has to work. For a 30-year mortgage, it's expected things to happen. When you make an extra payment, and if you do that, make sure on your mortgage coupon that you send in that you make a note on the coupon, additional principal, because they could just apply it to another payment, and then you'll be a payment ahead all the time, but the math still works out. If you are trying to make an additional interest payment, be sure to note it on there, because see what happens when you make that additional interest payment, the math gets screwed up. To put it nicely, it gets really, it still works, but all of a sudden they're expecting you to have a balance of this for them to charge interest. Well, obviously your balance is lower, so your interest is lower, but you're still making the same payment. Now, again, I like I said a couple of times, for many of us, it's hard to make that extra mortgage payment once a year. Here's a suggestion, and it pretty much works out the same way, and it's a lot less painful. Look at your mortgage payment and look at just the mortgage part of it. Forget about the taxes and escrow or PMI, whatever else is in there. The mortgage payment. Take 10% of that. So say if your total payment is $1,500, your mortgage part might be $1,300 or $1,100, whatever. But whatever part that is, take 10% of that and make that payment every month. So in this case, say if give you round numbers, your mortgage is $1,000, but your total payment is $1,500. 10% of $1,000 is $100. So make a payment of $1,600 a month. And just note that this is additional principal. Okay? Make that payment every month. That will have the same result as if you paid once a year. It probably have a little better result because you'll be paying 120% of a payment instead of 100% of a payment over a year. So again, let me run that through real quick. Whatever your mortgage portion of your total mortgage payment is, take 10% of that, add it to the total, and note on your payment coupon additional principal and put that amount. That way they will apply it directly to your principal. Have the same effect. Now, yes, you will cut out your mortgage, 5 years of mortgage, approximately 5 years, which say, okay, for round numbers, let's say you cut out 60 payments, but you're making 25 payments to get that 60, because for the 25 years you have your mortgage, you're making an extra payment. So just be aware that it's not as always as cut and dry and pure and simple as everything else. But that is one way to really cut down on your mortgage. Now, if you do that, how much will you save in dollars? Remember, we're talking about that pure interest, that real interest. The true interest rate on a 4-year mortgage, if you make all your payments on time, just the payment they tell you to make, you're going to pay about 72% in interest over 30 years. Forget all that 4%. You're going to pay 72% more than you borrowed. If you make that extra payment, whether it be once a year or every month a little bit, that 72% drops to 59%. That's the difference in that 10%. Your total will be, I think I did the numbers, it goes from like $140,000 you end up paying over that time period to about $118,000. So you save about a little over $20,000 just by doing an additional payment. Okay, that's how the math works, people. Okay, so instead of going, okay, here's my mortgage, how do you do that? You know, we did personal budgeting last week. If you have the space in your budget, add 10% to your mortgage payment right there in your budget, and every month pay that. But just be sure to note on your coupon that you return with your mortgage payment. And this would mean you probably can't pay it online, so you probably got to pay for a stamp and an envelope. Okay, it's going to eat into your savings a little bit, but note on there that this is additional principal, and that way they'll put the money right on your principal. Okay, so those are 2 mortgage myths that I knew, that I heard of, and that's how they work. But I tell you again, go and Google building an amortization table in Excel. It is very, very easy, and I'm all about you understanding how the math works. That's how the math works. Once you understand how the math works, and you know, believe me, I got like everything we talked about, I got like 5 different tangents I could have gone off on. It was hard to just say I'm talking about this. We're going to talk about credit cards, how those work. The math is kind of similar, okay? It's not rocket science, people. Let me rant for a minute. The financial industry has a vested interest in telling us that these things are hard to do, that the math behind these things is too complex for our simple brains, okay? So we shy away from it. My goal with this show is to demystify, to pull back the curtain, and you can see that the man behind the curtain isn't the great Oz, he's just an old guy. The math behind this stuff is not hard. Sometimes some financial professionals try to make it hard so that you won't try to understand it, but it's not hard, okay? So anyway, there was something else I wanted to say, and I can't remember what it was. While I was talking, it came to my mind, and I apologize. I'll probably remember as soon as I say thank you. But hit me up. The email address is thesecretmathofmoney@gmail.com. I have a YouTube channel called The Secret Math of Money. This video will be uploaded, just like the last 2 were, the introduction and the personal budgeting video. I want to stress, I am not asking anybody for any money. I am not selling any service. I am not trying to become your financial advisor. I see people out there I'm not trying to do that. I'm not qualified. I will say it like that. When we talk about stocks in a couple of shows, I'm going to break down how I look at stocks. It's crazy, I will admit, compared to what I've read in books. My background, I have degrees in accounting and finance. That's it. Okay, I have degrees in those fields. And in those fields, I have had to learn a lot of things. And I feel like I had to go through and learn this stuff. I don't want to die and take this knowledge with me, and then the next person's got to sit down and relearn it, because it is not rocket science. A lot of this stuff is truly not rocket science. They make you think it is, but it's not. Okay? So anyway, again, I thank you, everybody who tuned in. Family, friends, all you guys, I appreciate it. This video will be available on Facebook Live, as it is right now. It'll be on YouTube, and it should be on iTunes later today or by the end of the weekend as a podcast, okay? So, with that, everybody, again, I thank you for your time. I thank you. Appreciate it. If you got any questions, any please let me know if there's something you want to talk about on a future show. Shoot me an email, hit me on Facebook Live. Say, hey, I want to know about this. I didn't get into reverse mortgages. And yeah, that's another thing. That was probably what I was thinking about. But basically, you sell your house and you get your money now, and then when you die, they get it. That's reverse mortgages. So anyway, everybody, have a great day. I will talk to you soon. Take care. Bye-bye.